Welcome everybody to the PFA halftime report. This is just a real quick look at the markets and the economy that we like to do halfway through the quarter. You always get a chance to see what's going on at quarter end, and we decided that it's a good idea to catch up with you in mid-quarter and let you know what we're looking at and the types of things that we're seeing out there and that are instructing the decisions we make for your portfolios. So we're halfway through the third quarter already. The recording date for this is the 16th of August. And my name's Jim Bradley. I'm the Chief Investment Officer here at PFA. And as per usual, joined by our portfolio manager, Sam Chaplin. Hi, Sam.
Hey, Jim, how are you?
Great. Good to have you on board. As is typically the case, we're going to kind of take a 35,000-foot view of some of the things that we're seeing in the economy. We'll then just kind of drop our focus a little bit more narrowly into how that relates to, what we're seeing and what kind of trends we see coming out in the markets. And Sam's going to wrap it up at the end with a bit of an outlook as to what's kind of guiding our views going forward. So with that brief introduction, I'm going to turn it over to you, Sam, to give us a little look at one of the things that obviously we're still hyper-focused on, which is inflation.
Yeah, thanks, Jim. Yes, we are still talking about inflation. It is still out there and an issue. As you can see in this first chart here, looking at inflation in the green line, got what's known as the headline inflation number, which is just based on a typical basket of consumer goods and how the price has changed over a year-long period. I kind of stretched out the time frame here so you can see what a more normal inflation picture looks like versus what happened during COVID and from all the stimulus post-COVID. As you can see here, the headline number in green topped out around 9% in July of last summer. It's retreated all the way back down to 3.18%. So that is some really solid improvement there overall, and seeing some moderation in those price increases. Over on the core side, still a good improvement in inflation. So that core number is excluding things like food and energy prices, which are more dictated by the global markets than it is by U.S. policy and interest rates and all those type of things. So we kind of strip those things out to get a clearer picture of what the Fed does have some control over with higher interest rates, and that has come down from a peak of about 6.64% down to 4.7%. So good improvement there, but that's the number we really want to see get back down towards those normal levels around 2% before the Federal Reserve can get too anxious about lowering interest rates. Otherwise, we risk resurging in inflation, and that would be a really bad outcome. Within those numbers, too, we're seeing some under the hood, some improvements. For example, rents, which have been one of the stickier inflation numbers, are still pretty high on a year-long basis. And this basket of goods, it's looking at what's the average rent out there at the moment, and that's still pretty high. But if you look at rents and leases signed in the last few months, the pace of inflation has come down significantly there. So likely to see some more improvement as those numbers work themselves out over time. And the reason we're primarily concerned about inflation beyond our pocketbooks or wallets is because it has an impact on how the Federal Reserve will be able to handle their interest rates. On this next slide here, you can see the path of Federal Reserve interest rates over the past few years, and kind of a normal cycle there between 2016 and 2020. And as we know, that's when things went a little bit sideways. Interest rates got dropped to zero, and has since been working themselves back up at one of the fastest paces in history. And the reason it is one of the fastest paces is because the Fed was a little bit late getting started hiking interest rates. They didn't really get started until about the time that inflation was peaking. So they had some catching up to do, some really big interest rate hikes there, slowing down more recently as inflation has been coming more under control. The question now is, how high do the interest rates have to go? But even more so than that, how long do they have to stay high until inflation can normalize and the Fed can feel comfortable lowering those interest rates back down? So we think of these interest rates as a way that we balance price stability from inflation and growth. So we want those interest rates to be high enough that it slows demand enough to slow inflation, but not so high that it slows demand and puts us into recession. So it is a bit of a balancing act. It's something very hard to predict. Everybody's got an opinion on it, and they're wide ranging. But at the moment, growth has remained really positive, and that's had the market moving a little bit in the direction of thinking interest rates are going to have to stay higher for longer. If you had asked somebody a year ago, they would have said interest rates at this level, there'd be massive layoffs, there would be earnings would be in the tanks, a lot of bad things happening, and we've been really surprised to see that growth has stayed really positive. The labor market's still really strong, as Jim's going to get to. And overall economic growth on this next slide here has been remained in positive territory. This chart looks a little bit more like an EKG than it does like an economic growth chart, but those big swings there from COVID. But before that, we tend to average around 2% growth a year, and we're a little bit above that level at the moment now, after dipping slightly into negative territory, but really nothing to sweat about there. So again, much more positive outcome than people would have thought a year ago. It has a lot to do with how strong the consumer has been, the labor's market's been. So I'll kick it over to Jen to talk a little bit about that.
Sure. Speaking of inflation, I mean, yeah, it's nice to see that headline number coming back down, but it's this time of year that I think a lot of people are buying airline tickets and hotel rooms and that type of thing and wondering, I thought inflation was going down, and they're not seeing it in the service sector, which has definitely proven to be a lot more sticky. But as you mentioned, consumers are holding in there. And on this slide, we can kind of see, what the story is behind that. When we look at the overall US economy, it's broken up into, the activity, the gross domestic product, or GDP, is broken up into a few different areas as to what contributes to it. But by far, always, historically, the biggest contributor to that is us. It's the consumer. And the consumer, which accounts for, depending upon the year, somewhere usually between 60 and 70% of gross domestic product, has still been there to keep us going and keep us at that 2% level that you've seen. And this is what's kind of leading a lot of analysts, economists to think that this big recession that we've been kind of waiting for the past 12 to 18 months hasn't really started to materialize. And it's got a lot of talk about whether or not we might actually see this thing they're all calling a soft landing, where the economy maybe doesn't really go into a strong recession. And for some people, the estimate is no recession at all. And that comes as a result of what we're seeing right here. The unemployment rate stays stubbornly low. There's still about a job and a half in openings for every one individual looking for a job. And that's certainly putting some, creating some slack in the job market that's holding that unemployment rate down. And the kind of cousin to that would be US retail sales. That's where we as the consumers are, making our contribution to keeping the economy going. And you can see that obviously there was a big drop off in March and April of 2020, but all the stimulus that came out really gave that a boost. As that stimulus wears off, we might expect to see those retail sales curtail a bit, start to go down, but they've really kind of been going sideways, and the consumer is continuing to spend at a level arguably higher than the pandemic in the first place. That could be a result of a lot of things, including the leftover stimulus money that was out there. But importantly enough to us, the worries about Fed actions and that type of thing haven't really started to weigh too much on the consumer. And where there have been slowdowns, it tends to be more on the corporate side, and with companies kind of looking ahead and being a little bit more cautious about the hiring that they're doing and the capital spending that they're doing as well. We've seen a recovery so far, and hopefully that recovery continues to go in the same direction as it has. This next chart's a little bit weird. Some people will look at it and say it looks a little bit like a performance chart. It's really what we call a drawdown chart. And in this sense, it allows us to just kind of see with stocks, which we measure using this Morgan Stanley Capital All Country World Index, and how far it came down and how far we've come back up to hitting the high. So on a chart like this, just to kind of give you a little bit of orientation of how to look at it, we're never going to go above zero. Zero is back to reaching record highs, and coming down from that is what we're actually concerned with. So the big drawdown, quote unquote, from the stock universe was relatively substantial. You can see it was down almost 28% back in the latter part of 2022. And 2022, you may remember, was not a great year for stocks, but it was also a pretty lousy year for bonds too. And they went down with the Bloomberg Global Ag, which is a hedged bond index, going down almost 15% at the same time. So bonds, which are usually supposed to give us a little bit of a hedge against stock market volatility, we can see 2022 didn't do that. The question is, where are they on their way back? And it looks from this chart like they're not as far recovered back up to where they left off. And that's largely as a result, most likely, of the Fed not being convinced yet that it's time to start loosening up monetary policy, which from our standpoint, as practical investors looking into the future, gives us hope that there might be a good bit more room to climb out in the bond market. We've got two factors going on here: higher yields that could protect us a little bit price-wise in case rates continue to rise. And if rates level off or start to come back down, that bond portion does have a good bit of a way to recover. And our expectation, our base case, is that eventually it does. It's just a matter of how long it takes. And so it's got a good ways to come back too. So people thinking about a recovery should be thinking about both ends of that spectrum, whether they're looking at stocks or bonds, and maybe even focusing a little bit more heavily on the potential return of bonds. A lot of frustration out there in the world, and this is not just with us or our clients, but pretty much every investment committee I'm a part of, pretty much every individual investor out there looks at this bounce back in this S&P 500 and says, gosh, it's really been relatively substantial. And as of this chart, which we ran last month, the S&P had been up on the year by 16%. And realistically, not very many people have actually gotten a chance to see that kind of return on the stock side of their portfolios. And that's for a lot of reasons, but the biggest reason is the one that you're seeing in front of you right now. The S&P 500, if you get by its name, represents 500 companies, and usually 500 of the biggest domestic companies, but it's what we call a capital weighted index. And all that means is that bigger companies move the index more than smaller companies. And 7 companies, Meta, Amazon, Apple, Microsoft, Google, Tesla, Nvidia, they make up a big part of why the S&P is up as far as it is. They on their own were up on average about 58% at the first part of the year. So if you owned a portfolio with just them in it, you're looking pretty good. If, on the other hand, you owned a portfolio where you balanced out your holdings between all 500 companies or just kind of picked in general large cap companies, and they didn't happen to all be these 7 companies, in all likelihood, your performance hasn't been as good. So we look at the blue line on the bottom. The remaining 493 companies have just barely broken above being, down on the year. And as of about a month ago, we're up only 5%. Since this chart, there's been a little bit of convergence. Some of the rest of that 493 are catching up. The question is, how do we get back to kind of an average here? Are these high flyers that have arguably become very expensive, maybe as a result of being tied in with artificial intelligence technology and that type of thing, do they end up kind of coming back down to earth? Or do the remaining companies in the S&P 500, does the rest of the world start to catch up with the ground that these high flyers have taken? In our case, from a practical standpoint, when we're managing assets, we are very cautious about putting too much weight into these things that have really taken off, and are going to be patient. And patience has generally paid off in these kinds of situations, to let that other part of the S&P 500 hopefully catch up if we do run into a situation where we have a soft landing. If we do have a situation where we avoid any kind of a significant recession. There's a lot of value that exists down there in the rest of that. And so people who are holding assets outside of just those high flyers in the S&P 500, the one word I would use to give to you, and the one word that we're certainly using as a mantra when we're managing assets right now, is patience, because we think that your patience will be rewarded. And with that, I'm just going to turn it over to Sam for some of the trends we're looking at going forward.
Yeah, thanks, Jim. Three items here we're looking at going forward are monetary policy, stock valuations, and labor and capital. To dig into those a little bit more, monetary policy we talked about a little bit, but the question now is how long are those rates going to stay high, and are we going back to a super low interest rate environment like we've been in the last decade? We were in this really kind of uncommon decade over the past, really since the 2008 financial crisis, where we had very low interest rates and no inflation. Now the inflation cat is out of the bag, so to speak. So are we able to go back to low interest rates without a resurgence in inflation? And there are a lot of factors that go into that, whether it be advances in technology and globalization, keeping prices low. Are those things going to keep pace going forward? And that helps suppress inflation. The common market conception right now, at the beginning of the year, everybody was thinking we'd be cutting rates in the back half of the year as the economies remain strong, consumers keep spending money. Inflation's coming down, but there's still a lot of spending going on. So it might be too early to cut interest rates. So those expectations are being pushed out quite a bit, along with expectations for a recession going down as well. So that's very positive, but it does mean that we're going to be likely stuck with these higher interest rates for a while longer. So the new estimate, as I said, these estimates are not always accurate, but the new estimate is that we'll be cutting rates in the first to the middle of next year. Would be the first time cutting rates. The Federal Reserve has them getting down about 1% next year and about another percent the year after. So a slow pace, but again, that's a good thing. It means the economy is remaining strong. If the economy wasn't strong, those interest rates would drop a lot faster in order to support it. And kind of piggybacking off that a little bit is stock valuation. So higher interest rates are typically not very good for stock valuations. You think it's compressing the earnings of these companies. They are borrowing a lot. Those interest rates go up, the payments are going up, the earnings are going down. But the stock valuations have actually been coming up quite a bit so far this year, to the point where they're kind of at the higher end of the valuation range overall. To Jim's point before, there's a lot of dispersion under the hood there, though. So those big companies that are AI linked are valued higher than they have been in most cases, historically speaking, but there are still pockets of value out there in some of those other areas that have not run up so much this year that we're taking a quick look at, or deep look at. The other comment on stock valuations is that we got these higher interest rates, which typically bring valuations down, but we also have this promise of AI and all these applications that are going to be coming out for it. So your opinion on the stock market right now has a lot to do with whether you think the upside of AI is going to be stronger than the downside of higher interest rates, and which one of those forces is going to dominate. So exciting times to be watching going forward. These applications of AI are likely to make companies more productive and put out more goods and services that help boost GDP and all kinds of good things. So looking forward to seeing all the applications and how companies use them. Kind of similarly, but a little bit on a different topic, is looking at difference between the market and the economy, and that has a lot to do with labor versus capital here. And what I mean by that is that in the past decade or so, when interest rates have been really low, we've seen a lot of the new wealth in the economy accumulate to some of the upper classes. When you think about like CEO pay going up so dramatically, and also companies choosing to do stock buybacks instead of raising wages for their employers. And that's been good for the markets, been good for earnings. However, kind of at the expense of the workers of those companies. And we're seeing now that we have low unemployment, that balance of power is shifting a little bit back towards the labor side, where companies now don't have a huge pool of unemployed people to pull from. So it's more important for them to keep their workers, and those workers know that, and now they're going to leverage that power. And we're seeing a lot of like foiling of strikes and whatnot, as far as we saw the writers and actors striking. We've seen UPS looking like that the auto manufacturer is going to be striking as well. So it's the type of thing that shows you the difference between the economy and the markets. For the economy, I think that's a great thing. It's going to help the those wages catch up a bit that have been stagnant for a while. But from the market side of things, not so much. It's going to compress earnings. These companies are now going to have to deal with higher interest rates and higher labor costs. So a little bit of a downside there from the earnings. But just interesting to see these things manifest over time. So with that, we'll let you get back to your lives, and appreciate you tuning in for a few minutes here, and we'll see you next quarter.
Yeah, looking forward to it. Be on the lookout for our complete third quarter commentary that should come out in the first part of October. And Sam and I will sit back down again with you just before Thanksgiving, and we'll do another halftime report on the fourth quarter. So come on back and join us then. Thanks for joining us today.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct.